right now. Your next news update is at 9. Chicago's Morning Answer continues next on AM 560 The Answer.
Now, from the Signature Bank Studios.
Only the biggest stories, only the biggest guests, and only the biggest opinions. This is AM 560, The Answer.
Top of the morning, Dan and Amy. Good news for Billy Bob Thornton and John Hamm. Oil is rallying. Bad news for us over the last week, us with 401ks and such, as the market is going in the wrong direction. I was told that it was only supposed to go up. For more on all things money and markets, we're pleased to be joined by James Perry, founder, CIO, Perry International Capital Partners. Jim, thanks for joining us. Appreciate it.
Thank you, Dan. Good morning.
Good morning. I see futures are down this morning as well. NVIDIA leading the losers. That's not good news. NVIDIA sort of key to the market rally over the last year. What is happening? What is with this surge in bond yields and bond sell-off, government debt sell-off, and the market faltering?
Right. Well, as usual, there's a lot of moving parts to all of this, right? The key issue is the stock market does not like bond market volatility, right? And that translates directly into the volatility in the stock market. The VIX, which is the sort of main metric in volatility, has gone from sort of 12, 13, 14 up to 20, 21, 22. So you've gotten a 50% increase in the volatility in the stock market. Why is that? Pretty simple. The 10-year Treasury is trading at 480, just below that right now. And the 30-year bond is just under 5%. So we've talked about this before, but, the U.S. economy is actually doing quite well. The non-farm payroll number, as you know, came out Friday. We got a decent number, 256,000, and the unemployment rate dropped to 4.1%. So you'd think on something like that, the stock market would have done well on Friday, but instead it was, the Dow was down 700 points. So what's driving stocks? Very simple. Higher interest rates are a reflection of higher inflation expectations, and that has to stop for the stock market to stabilize here.
Well, we have 7 days until President Trump is sworn in for a second term. Is that going to help the stock market?
5 business days, right?
5 business days, excuse me.
It's next Monday, right. I've talked about the January 20th first day of the new administration for a while, and I think the market is going to do well. Maybe not right on the 20th, but you're going to see a sweeping array of policy initiatives that will go into effect immediately. And investors are going to have to really digest a lot of information. And it's not just economic stuff or the Fed or the Treasury, right? I'm talking about international stuff. I mean, there's a lot of movements in these negotiations in Ukraine. There's a tremendous amount of political and geopolitical strategizing about the Middle East. And, of course, the number one issue is what do we do with the containment of China? So there's a lot going on behind the scenes, and a lot's going to change really, really quickly.
Going through your newsletter, though, I see basically, the American consumer, and consumer spending represents about 70% of GDP, is in a pretty good position, generally speaking, with, credit card debt, for example, as a percentage of disposable income is below pre-pandemic levels.
Right.
Debt to disposable income is declining. So we seem to be in the consumer seems to be, the median consumer seems to be in a relatively good position. So what does that portend for 2025?
Good observation, 100% correct, Dan. The U.S. economy, with respect to consumer spending, is really doing quite well. And it has been for the last sort of quarter or two. Which begs the question, why in heaven's name did Fed Chairman Powell cut interest rates 100 basis points since the middle of September, right? In an election year, right? In the fourth quarter, 100 basis points. What the market's telling you, the Fed didn't need to stimulate the economy anymore. This is why, at the same time, from the September 16th Fed cut all the way through to really today, the interest rates at the money market level, overnight money, has gone down 100 basis points, but 10-year treasuries have gone up over 100 basis points. So the bond market gets it first, right? And the FX market gets it before that. And just a quick note, the dollar has been flying higher, right? It made a new high again today for this cycle, well above 110. And the fact is that interest rates are going up because the spending that's coming out of Washington is probably higher today than it was a month ago or a quarter ago. These guys are trying to spend as much money as they can before austerity hits the U.S. government, which it's going to do.
So right, and so that is the key fiscal policy, is for spending restraint to be in some material way to be visited on Washington.
100%. These spending cuts are the issue for the U.S. economy going forward in the next quarter or two, for sure.
And then if the Fed was too stimulative, cutting rates in the fourth quarter, then what can we anticipate in the first quarter this year?
Well, the Fed next meets on the 29th of January, right? And in the futures markets and the derivatives markets, just a little background. A year ago in January, the market was expecting 6 rate cuts, right? We got 3 at the end of the year. This year, the market is expecting none, right? So on January 29th, you will probably, more than likely, not see more stimulus from the Fed. The economy doesn't need it. Consumers are in great shape, back to your point, right? Businesses are in great shape. Business balance sheets are stronger than they have been from pre-pandemic. Households the same. The banking industry, right, the financial system is got ample reserves, as does the Treasury. So the economy's got plenty of liquidity, and it's also being supported by liquidity that's coming from foreign central banks, right? China continues to stimulate. Europe continues to stimulate. Japan continues to stimulate. So there's a ton of money in the system, and where the rubber meets the road is that all of this spending, because this is the biggest economy in the world, the percentage increases are one thing, but, think about that national debt level at $36 trillion. That's got to be financed in the bond market every week. This is the big problem. So everything starts here.
Trump had this little gathering of governors late last week in Mar-a-Lago. And in the Q&A with the press after, he talked about all the CEOs that are visiting him, erstwhile political enemies at one point in time who are now making nice, like Bezos and Zuckerberg. So much of people's outlook is it has impact. The sort of attitude and outlook has impact on consumer confidence, on confidence in the economy, confidence in taking risks. It has real economic impacts. The sort of the national mood, the national mentality. With him having these CEOs saying nice things and being excited about working with him in a constructive fashion, and in Zuckerberg's case, for example, shedding some of the censorious chains that he essentially argues were imposed upon him by the last administration. I mean, what I know it's hard to measure, but how important do you think that cultural shift is in terms of just a more open, pro-entrepreneurial kind of environment for the U.S. economy?
I think it's extremely significant, Dan. The cultural waves going through this country over the last 4 years, or even sort of 12 years, have been really detrimental to free market capitalism. You look at things like the Constitution and the Bill of Rights. The First Amendment is free speech, right? You take that away, and everything disappears, and that's been suppressed for certainly the last 4 years, and if not, further than that. I think the whole cultural shift in the United States is long overdue. I think it's more powerful than most people think. I think it's a pro-growth, pro-American, pro-free market economy. I think everybody recognizes that we do not have free trade with our trading partners. We do not have security at our borders, and we do not have the rule of law that's actually following the law. And I think part of the reason that this administration came into power is that culturally, socially, people are really just fed up with it. Not just the costs, but the dangers, right? The threats that are hitting every household and every business, right? Crime and looting and this sort of stuff. It's got to stop. And finally, people are waking up to it, saying, the reason we got here was because of all of this nonsense that's been pushed out by the social media and the mainstream media for years. And I think people are fed up with it, quite honestly.
The thing you worry most about in the Trump administration in terms of policy, the top of it, as you sort of indicated, would be to not get substantial spending reduction done. That's number one, I gather. But is number two another concern, any sort of significant trade war with a major trading partner or two?
I think that the tariff and trade issue is greatly misunderstood, and I'll get to that in a second. To your point, the ability to actually materially cut government spending is the most important domestic issue, right? And I did a podcast on Friday after the non-farm payroll number, and I get a lot of blowback on this, especially from my European client base. Most people, not most, maybe half the market doesn't believe that spending cuts can actually materialize. And I said, well, let's just think about this for a second. Do the math. The government brought in $5 billion worth of tax revenues last year and spent $7 billion. So your deficit's $2 billion, right? Pre-pandemic, the deficit was a quarter of what it is right now. And much of the stimulus spending is still in the economy, waiting for government agencies to spend it and distribute it. So this is the cause of inflation, right? So if you can actually cut $500 billion or so from this $2 billion budget deficit, 25%, I think that's a manageable number. And I brought up the point that, Javier Milei, right, the new president of Argentina, he was elected in November of 2023. At that time, the Argentinian economy was inflating at over 200%, 211%, right? Now it's 3%, all right?
Mm-hmm.
Can you imagine? 200 to 3. And how did he do it? He cut government spending by 30%, right? That's it. Bond prices went from 25 cents on the dollar to almost 70, right? This is a tripling of the price of a bond in Argentina in a year. That's just unprecedented, right? And yields went from something like 24% down to 9%. And the Argentinian stock market has almost quadrupled, right? So if you can imagine a 25% cut in spending here, imagine the support and the tailwind to the private sector of the U.S. economy versus the non-productive portion of the public spending. It will be phenomenal. So I'm very bullish on the economy going forward. Now, we've got to get through this high interest rate thing first, and maybe it's Monday, and maybe it's, the end of the first quarter or something. So I've been short bonds for 3 years, and I'm not going to buy any right now, but at some point here, bonds are going to be a pretty good buy, and I'm just waiting to buy the dip on that. And when bonds become a buy, the stock market's going to become a buy.
And the prospect of a trade war or trade wars is a significantly less of a concern to you. Explain.
It really is. A lot of people think that tariffs and trade wars are inflationary. And historically, that's true. They talk about Smoot-Hawley back in the 20s and the cause for the Great Recession. That's a whole different category than it was now. You got to remember that, and I just was reading this morning, China was reported this weekend, right, last night, reported that their trade surplus, so this is the Chinese economy trade surplus to the rest of the world was $1 trillion in the last 12 months. $1 trillion. Half of that is to the U.S., right? Now, a lot of that is front-running tariffs and the fact that imports into China have collapsed because of, sluggish domestic demand, stuff like that. But the point is that to reduce the trade deficit in this country, which Trump wants to do because he considers it a subsidy to the Chinese Communist Party, all you have to do is say, you want to keep sending stuff to this country? Great. The price is going to go up by double or whatever, some number, right? That's a threat, right? So what's China going to do? They're going to cut the cost of the goods they export to keep the 400 million people in China who are using or working in the manufacturing sector for exports to the West. Because if they don't keep them working, the Chinese economy collapses and the Communist Party is under threat. Probably the largest threat to the Communist Party that they've had really since Chairman Xi's been in power. So I think the trade deficit and tariff idea, if people just look at it in terms of increases to consumers, I think they're looking at half the picture. The fact is, Trump wants to get that balance back down to zero, and China cannot afford a trade war to this country. Mexico cannot afford a trade war to this country, nor can Canada. They have to cut prices, and they have to start importing goods from America back to their countries. Otherwise, their economies will go into recession. So when people talk about inflation, they forget that, these trading partners, if they can't export to this country, they're out of business. That's very deflationary, and people forget it. And the other thing is the dollar, right? You think about China, Canada, Mexico, Europe. If tariffs go up and their exports go lower to this country, what's the currency going to do? The dollar's flying today, again, all week. The euro is almost at parity to the dollar. It's trading 102, right? Same with the yen. Yen's back up to almost 160. So these emerging market currencies are collapsing. So the idea that the dollar is going to go up against all these other currencies, this is tremendously deflationary for the U.S. consumer. So I really take quite a big issue with some of these economists that say this is so stupid and the deficits are going to get worse and Trump's doing something really stupid and arrogant. And, he's got his style, don't get me wrong. But the point is, and I wouldn't do a lot of things that he does the way he does them, but the point is that the getting trade surpluses back to balance is the best thing we can do for this country, and it's long overdue.
James Perry, founder, CIO, Perry International Capital Partners. Jim, thank you as always.
Dan, thank you. Have a good week.
All right, you too. Thanks. And he joined us on our turnkey.pro answer line.
This is the morning show more Chicago radio listeners are choosing. This is Chicago's Morning Answer on AM 560. The Answer.
Signature Bank is Chicago's fastest growing independently owned business bank. It's a bank where relationships still matter. Signature Bank knows your name and your story. I'm Dan Proft, and I know this because Signature Bank is my business bank.
I'm Jim Durkin, founding partner of the Martech Group, a global market research firm based in Chicago since 1985 and a longtime customer of Signature.